Good morning. You're watching a live market outlook for Wednesday, 16th of November 2011, prepared by Windsor Brokers. The European scenario keeps to be the main driver of the markets today, overnight, and expected likely to continue today as the mounting fears about possible worst scenario of ending this debt crisis is keeping the pressure of the markets with the euro and sterling hitting fresh lows after breaking some key support levels, while also the commodities such as gold and crude oil remain under near-term pressure and keep off highs overnight during the overnight session. The Eurozone is looking for some respite today, with Italy due to unveil the technocrat-led cabinet and the new Greek coalition expected also to win a confidence vote, as the battle to prevent its debt woes continues, and actually the fears of dragging down the world economy are mounting now. The former EU Commissioner Mario Monti is set to inform Italy's president that he has assembled a new government whose most pressing task will be to get a fractious political class to agree to painful structural reforms designed to rescue its debt-laden finances. On the other side, in Greece, the new Prime Minister Lucas Papademos is expected to easily win a confidence vote, but rebuilding Greece's shattered finances will be a daunting task, with his national unity government that's already split over new austerity measures. With the financial markets skeptical that unelected technocrats, because the governments are now made by the experts for each field and they are not coming from the elections, that will have the political clout to impose unpopular reforms. The two-year debt crisis risks further spreading to the entire currency bloc and actually hurting the global growth. As a result, the shares in Asia were lower during the overnight session, as signs that rising borrowing costs were affecting also AAA rated France steered fears that even core Eurozone members might not escape contagion from the region's debt crisis. Yesterday there were also some comments about Austria that was holding the firm AAA rating. Might come under magnifying glass of Fitch and S&P, as their experts are traveling to Vienna to see whether the Austria is to be downgraded or not, as the main trading partner of the country is Italy, and Italians' current huge exposure might affect all surrounding countries as well as countries that have close economic ties with Italy. Euro also, as I mentioned, hit a 5-week low after breaking below 35 and 34.83 key support zone and standing to close to 34, as well as sterling after losing a floor of the recent range, extended losses to 157.50 so far. The markets are expecting a circuit breaker to alleviate pressure on periphery bond yields. One of the analysts said during the night, if no announcement is forthcoming in the days ahead, one suspects that situation could unravel fairly quickly. So we are still quite high risk of further deterioration of the current situations. From the US, the US Treasury Secretary Gaitner said Europe had a difficult task in boosting the creditworthiness of some of its economies while also boosting growth. And that's a difficult balance You can see, as Gaten said, they are struggling with it, but he thinks that they are gradually making progress. France, actually, as we mentioned earlier, has become the latest Eurozone member to come under pressure after a spike in its borrowing costs on jittery bond markets, fueled concerns that the Eurozone second biggest economy was also being sucked into the spiraling debt crisis. From the other side, today's announcement of the UK's CPI and unemployment, that is the outlook is already grim, is expected, if comes at forecasted levels, to put further pressure on the national currency, the British pound. The Bank of England may flag today the need for yet another cash injection to shore up economy when it updates growth and inflation forecasts will be announced today, as the Eurozone debt crisis threatens to tip Britain back into recession. The Bank of England restarted its asset purchase program in October with the fresh £75 billion cash boost, and the policymakers had considered pumping in even more due to the gloomy outlook for the economy. Many analysts reckon that Bank of England will use today's inflation report to signal that more quantitative easing might be needed, as it looks set to predict a somewhat sharper slowdown in the inflation and much softer growth than in August. The Bank of England Governor King is also likely to sound a downbeat tone on prospects for the UK economy in this news conference that is due at 10:30 GMT. Reinforcing expectations, the central bank will raise its quantitative easing target from current £275 billion before too long. From the Japan, the interest rate announcement came. The rates remain unchanged, and the Bank of Japan kept monetary settings on hold today, but toned down its economic assessment and voiced concern about possible fallout from Europe's debt crisis, also signaling readiness to ease policy again if the nation's recovery come under threat. As expected, the Bank of Japan maintained its key interest rate at a range of 0 to 0.1% by anonymous vote, and held off loosening policy further via an expansion of its asset buying scheme. From commodity markets, as I mentioned, the gold and the crude oil, as well as some other precious metals, were declining during the Asian session, as the threat of worsening Eurozone debt crisis and investors fleeing to the dollar. Dollar now became the most popular nowadays safe haven instrument. The spot gold is around nearly 1% in more than 2 weeks, as crude oil also fell from a 16-week high, easing down to 98.50 zone. However, the crude oil is, as we can see now, on the hourly chart, is back to strength and is traveling, approaching actually 99 level. More of this will be seen in our technical part. Now, a quick look to today's calendar. As mentioned already, the Bank of Japan kept overnight rates 0 to 0.1%. Next to come at 9:30 GMT is from UK, the unemployment rate that is expected to increase to 8.2% compared to the previous month release at 8.1%. And Claimant count change is expected to come at 20.4 thousand versus previous month release of 17.5 thousand. Average earnings index is expected to drop by 2.5% compared to 2.8% previous month release. Bank of England inflation report, as I mentioned, is due at 10:30 GMT, while from Eurozone CPI yearly CPI is expected to stay unchanged at 3%, as well as core yearly CPI at 1.6%. At 10:30 also, after the Bank of England inflation report, the Bank of England Governor King will have a speech and they will announce this inflation report. So this is due at 10:30 GMT. From Americas, also CPI data due at 13:30. Monthly CPI is expected to stay unchanged compared to previous month, 0.3%, while monthly core CPI also forecasted, for today at 0.1%. Versus the previous month, 0.1%. Capacity utilization rate in US due at 14:15 GMT is expected slightly to grow to 77.6%, and compared to 77.4% previous release. While monthly industrial production is expected to grow by 0.4% versus the previous month, 0.2%. US crude oil inventories are due at 15:30 GMT, and the draw of 1.3 million barrels is forecasted for today, compared to the last week's draw of 1.4 million barrels. Now let's take a look on the technical part and see the latest movements in the market. We are in euro-dollar chart as shown here, a loss of 135, 134.83 previous high posted 10th of November. Has accelerated losses of euro-dollar, testing so far 134.28, where the bounce is now emerging on oversold hourly studies. Immediate barrier at 135.00, where also comes the 20 days moving average, comes with the 135.50.70, which is the previous which is actually yesterday's consolidation range, and 38.2% Fibonacci retracement of the recent slide from 138.10 down to 134.28. This zone is expected actually to contain the corrective bounces, as we can see here, 135.50, 135.70. It's offering a strong resistance and is expected to contain actually the bounce higher, as the studies remain firmly in bearish tone. Also the daily outlook, the MACD on the daily chart is now below the center line, as well as momentum, so signaling further weakness, with the 20 days moving average on the daily chart currently at 137.91, maintaining the recent downtrend. The British pound also extended the losses after losing support at 158.70, which was the recent 3 weeks range floor, and extending losses through 158.50 and 158.00. Next support levels to hit 157.50. So far, this is also the low of 21st of October. Further Further decline is looking for test of 157.20, 157.00, which is the first one is the Fibonacci level of 61.8% of the broader uptrend from 152.71 up to 161.60. Pardon, 50% Fibonacci retracement of 152.71 to 161.64, and then we have 157 as a round figure. Further extension lower would target 156.81 and 156.30 on a break of the previous ones. Corrective action currently on the oversold hourly studies, currently testing 158 zone, which is also the hourly 20 days moving average, with 158, 50, 70 the previous resistance, and also previous range floor seen as a main barrier and expected to limit the upside for now. Break above 158.50, 159 would bring the pair back, would actually ease the current bear pressure and bring the pair back to the previous 3 weeks range. However, the near and short-term outlook remains fairly bearish for now. Dollar yen is still trading in the sideways, near-term sideways consolidative mode, just above 76.80 2 days ago, fresh low, with upside mainly capped by 77, 77.15. The studies are still focusing to the downside as the hourly MACD breaks below the center line as well as momentum, and the price holds below 20 days moving average, currently at 77, which is currently showing a more neutral reading. Break above 77, 77.15 is to signal some fresh gains. However, the spike high at 77.50 posted yesterday is our main near-term barrier, and only break here is to open way for a stronger recovery and a possible test of our key barrier at 78.00. On the downside, loss of 76.80 opens 76.50, 76.30 and 76.00, unless Bank of Japan reacts. However, they didn't mention anything in their post interest rate press conference. They didn't mention anything about intervention, except that they are ready to protect the economy and the currency from further strengthening. So the intervention from Bank of Japan is still in play. The dollar Swiss is in firm uptrend after yesterday's brief correction from gains just shy of 92. Our initial target reversed from 91.96. The support was found at 91.40-50 zone, which is the area of the previous high posted on 10th of November, ahead of fresh rally. Break above 92 barrier, our initial target, has so far touched 92.21 high, with the next barrier seen at 92.50 and 92.78, ahead of final push towards 93.13, our main short-term target, the high of 6th of October. Currently over extended hourly studies are in the corrective mode. The pair is actually in corrective pullback, currently below 92.00, with the 20 days hourly moving average at 91.70 being tested so far. 91.50 zone is expected. This is also the previous high, and reversal above this level is ideally to keep the short-term bulls intact for fresh rally higher. A break of 91.50 might signal some stronger pullback, but overall bullish tone on dollar Swiss remains in play below, while holding above 90.00, the psychological support. Now back to commodities. As we can see on the Ichimoku studies for gold, The yellow metal is firmly above the daily Ichimoku cloud, keeping the short-term bulls in play. With the current consolidative short-term trading expected to proceed fresh rally higher. Some hesitation is seen on gold price action due to the increased fears of the possible spreading of debt crisis to the other countries in Europe after Greece and Italy. Spain is the next candidate, so the investors are a bit more cautious at this point and likely taking profit and moving their investments in the short term into US dollar. That's why the gold is currently stuck within 1735, 1800 range. However, the outlook remains still bullish, especially on the daily chart, where we can see that yellow metal is firmly supported and holding above 1750, 1735 keeps the prospect for a retest of 1800 and then possible extension up to 1828 and 1844 with the short to medium term target seen at 1885 and possible test of historical high at 1920 posted 6th of September. At this point, only break below 1735, 1700, that was also previous strong first support and then resistance, might delay the current bulls and they allow for a stronger pullback. Supportive point also on the daily chart is current break above 20 days, moving average above 55 days. While 55 days is maintaining the downside, and this gives the more positive tone. Overall picture is well supported by 200 days moving average, currently standing at 1588. Crude oil has extended gains further towards $100 per barrel level, with the 99.83 seen so far ahead of current easing, as mentioned at the beginning of the session, that investors are a bit more cautious and mounting fears of the spreading of the Eurozone debt crisis. However, the crude oil remains well supported and the near-term and short-term outlook are firmly bullish, with our target at $100 per barrel now becoming more realistic and likely to be seen in a short-term trading above 100. Actually, we have initially the 61.8% retracement at 91.44. That has been briefly cleared. Now it's again as the price moved below, hit the 98.41 low of the day. This is the initial one, and then 99.83 and 100, above which to open 100.60 high of 26th of July. On the downside, 97.20, 30 zone is now the main support, and holding above here keeps the immediate bulls firmly in play, while loss of this level would signal some deeper correction ahead of fresh push higher.